Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. We're here on YouTube in the afternoon. Today, we're excited to discuss a very popular topic, which is the Mega Backdoor Roth Solo 401k. So if you have questions or topics that you want to discuss, please chat over your questions and topics. I see we already got a question, which is great. Thank you so much for bringing the question. So we want to get into the topic a little bit, but then we'll stop and we'll probably knock out a question or two. So you don't have to wait for us to go through all the slides. Now, we do want to spend a moment to talk about some of the resources. We go live twice a day on our YouTube channel, on our community, once in the morning at 10 a.m. Pacific, 1 p.m. Eastern, and then now we're back again here in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. So we're always here to answer questions live. If you subscribe to the YouTube channel and you hit the notifications bell, then you'll get the notifications. You can jump on the live stream and ask questions, hear what other people are asking, etc. So definitely subscribe to the YouTube channel. We have a lot of deep dive content as well that we provide. Like today, we're going to go through 2024 and 2025 Mega Backdoor Roth Solo 401k A to Z. And we're going to talk about it specifically for businesses that are taxed as an S-Corp or a C-Corp. But we'll be back next week, every day, twice a day, 10 a.m. Pacific, 1 p.m. Eastern, 1 p.m. Pacific, 4 p.m. Eastern. And then we're going to have some more deep dive content as well next week. So there's a lot of reasons to subscribe to our channel so you get the notifications. Now, the other way, you can see all the videos that we do host. I mean, we're prolific. So we love to talk about these topics. So we really appreciate the chance to discuss them. Now, the other thing that I'll highlight is our community. We have over 30,000 members. We have forums. We have a library of videos and webinars. So there's a lot of great resources, a lot of great ways to learn, a lot of ways to share the knowledge. So thank you so much for jumping on. So with that stated, of course, we got to let you know that the presentation is being provided for educational purposes only and should not be construed as tax advice, legal advice, nor as a solicitation. This is our community, by the way, mysolo401k.net/my community. You can see we got forums, etc. So, but yeah, let's jump into a little bit and then we'll circle back to some of the good questions. So of course, you know, if you have tax or legal questions, definitely discuss it with your tax attorney, with your financial professional, etc. As you can see, we got a lot of great content coming up. So subscribe. We're going to talk about, for example, strategy sessions as far as the magic number, how much income you would need to maximize contributions, as well as more of these Mega Backdoor Roth deep dive guides. Here's the roadmap of where we're going. We're going to talk about, again, 2024 and 2025 Mega Backdoor Roth Solo 401k contributions, specifically the limits. Then we're going to build on that to talk about scenarios and examples. We're going to talk about the resources like the online calculator. We're going to talk about all the specifics like the deadline, how to make contributions, how to report contributions, how to convert after tax to Roth. And then we'll finish it off with a bonus section talking about the $1,500 Solo 401k tax credit. So as far as the benefits of the Mega Backdoor Roth Solo 401k, oh, keep starting over here. Okay, where are you at? You must be on the StreamYard. Okay, yeah, please. Thank you so much. I'm not sure why it's doing that. I appreciate that feedback. We're also on LinkedIn. We're also on Twitter if you're on those platforms. So, but the benefits is that you can contribute a large amount and have it end up in a Roth account, where you've got that potential for tax-free growth once it's in the Roth account, right? So, for example, for 2024, you can contribute up to $69,000 or even $76,500 if you're age 50 or older. And even if you didn't set up a plan for 2024, if you didn't sign up with us by the end of last year, you could still set up a plan for 2024 and at least make the voluntary after-tax contributions, which would take you up to $69,000. Now for 2025, obviously there's plenty of time. For 2025, the limits have gone up. It's 70,000 or 77,500 if you're age 50 or older, or $81,250 because of the catch-up. So the super catch-up contributions if you're age 60 to 63. They've now introduced this super catch-up contribution bucket if you're age 60 to 63, which would take you potentially all the way up to $81,250, where all those funds could end up in a Roth account. And then you'd have all that potential for tax-free growth. So first step is find a mega backdoor Roth solo 401k. So of course you have to qualify, right? So you have to be eligible to set up a solo 401k, which means you're self-employed with no full-time W-2 employees working for any business owned by you or a spouse, if any. Then you have to, that's what enables you to set up a solo 401k, but then you have to find a solo 401k plan like our plan that supports the mega backdoor Roth. So of course, at a minimum, you need to have a plan like ours that allows for voluntary after-tax contributions and then in-service distributions, where you can move the money from the after-tax account to the Roth. So it can have that potential for tax-free growth. But then moreover, you're going to want to look for a provider like us that is going to assist you with all of the details, right? Because it is a specific type of transaction that you're engaging in. Like you have to have separate accounts, which we'll talk about. So you want to work with a provider like us that will help you establish the required sub-accounts, pre-tax, Roth, and then a third, voluntary after-tax. You're also going to want to work with a provider like us that provides the ongoing compliance support. Because when you make a mega backdoor Roth contribution and then move the money from the after-tax account to either a Roth solo 401k or Roth IRA, that move to the Roth account, that's reportable on a 1099-R. We handle that as an optional free service. In other words, no additional charge for our customers. All right, I know the individual that had the question, I think, was coming back on the YouTube. So we'll wait till you're back on the YouTube before we'll go through your questions. We'll keep going through these slides. So anytime we talk about contributions, right, it's always good to start with the basics. And there are certain basic factors that will influence how much you can contribute. One is your income. You can't save more than you earn. It has to be self-employment income. Another is your age, right? As we saw, once you're over age 50, you can start making a catch-up contribution. If you're age 60 to 63, you can make a super catch-up contribution. Do you participate in another retirement plan, like a day job 401k? The type of contribution that you're looking to make. So we've got different profiles of customers, right? Some individuals are solely focused on maximizing the Roth money in their plan, whereas others, they want to first fill up the pre-tax bucket and then whatever's left, make it as a Roth or a voluntary after-tax. Okay, so let's start to dig into those factors. Like I mentioned, you can't save more than you earn. So your ability to contribute depends on your self-employment income. Your self-employment income is what that depends on how your business is taxed. So for a self-employed business that's taxed as an S-Corp or a C-Corp or an LLC taxed as an S-Corp or a C-Corp, your ability to contribute is based on the W-2 wages that you receive from your self-employed business. Now, you can't use W-2 wages that you receive from other sources like a day job. You also can't use investment income, like the income that you receive as the owner of your S-Corp, like a K-1. Has to be that earned self-employment income based on W-2 wages, not passive income. Specifically, you use box 1 of the W-2 plus any pre-tax elective deferrals not in box 1, right? So if you make that employee contribution, you make it on a pre-tax basis, that's going to reduce box 1 and then be reported over in box 12. So you take box 1 plus what's in box 12, and that's your earned self-employment income when your business is taxed as an S-Corp or a C-Corp or an LLC taxed as an S-Corp or a C-Corp. Now let's start to look at those contribution limits. So you've got different limits to look at. You got the overall limit, and then you got the different sub-limits based on the type of contribution that you're looking to make. So looking at the overall limit, we've got here the 2024 and 2025 contribution limits, right? So for 2024, the overall limit is $69,000. And then it's another $7,500 if you're 50 or older. For 2025, that $69,000 limit increased to $70,000. The catch-up, if you're 50 or older, stayed at $7,500. But now if you're age 60 to 63, instead of the $7,500 catch-up, you're now able to make a super catch-up contribution of $11,250. Then you've got to look at the different subtypes, right? So a solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because you can make multiple types of contributions. In the words of the IRS, you're both the employee and the employer. So you can make both employee and employer. And then if you have a plan like ours, you can also make Roth or voluntary after-tax contributions as well. So let's start to look at those sublimits. So in terms of the employee contribution limit, employee contributions are also referred to as salary deferrals. Here, the limit is 100% of the W-2 wages from your self-employed business, taxed as an S-Corp or a C-Corp, or an LLC, taxed as an S-Corp or a C-Corp. 100% of those earned self-employment income, those W-2 wages, dollar for dollar, up to $23,000 for 2024, plus an additional $7,500 if you're 50 or older. For 2025, the limit increased to $23,500 plus an additional $7,500 if you're 50 or older, or an additional $11,250 if you're age 60 to 63. So that could take you all the way up to $34,750. Now, this employee contribution limit applies at the employee level. So if the employee is maxing out contributions to their day job 401k, they're not going to be able to make any more employee contributions to the solo 401k. So you need to reduce it by any other contributions made to another employer plan. Now that one exception, or I should say one exception to that rule, that you have to aggregate all contributions made by the employee to all the different plans that they participate in. The exception to that rule is a 457 governmental plan, in which case contributions are not aggregated. Now, the employee contributions, if you have a plan like ours, can be made as pre-tax contributions, which have the benefit of reducing your taxable income now for the year for which you make the contribution, as well as Roth contributions. Like our plan also allows for Roth employee contributions. Those contributions are made on an after-tax basis. So it doesn't reduce your taxable income now, but you've got the potential for tax-free growth because the money's inside of a Roth account. The second category you want to look at is employer contributions. Employer contributions are also referred to as profit-sharing contributions. Here, the limit is 25% of your W-2 wages. So that's where we want to go back to that definition, right? Box 1 of W-2 of the W-2, plus any pre-tax elected deferrals not in box 1. Add those together, multiply by 25%. That's how much you can contribute as an employer contribution. Now, you want to keep in mind the overall limit, right? The sum of all the contributions that you make to the solo 401k cannot exceed the overall limit, right? $69,000 or $76,500 if you're age 50 or older for 2024, or $70,000 or $77,500 if you're age 50 or older, or even $81,250 if you're age 60 to 63 for 2025, right? The sum of all the contributions cannot exceed those overall limits. Now, contrast the employer contribution limit with the employee limit, right? With the employee limit, it applies at the employee level. So all the contributions that the employee makes, including to the day job 401k plan, are aggregated and the sum cannot exceed that employee limit. Whereas the employer limit applies at the employer level. So even though someone has maxed out contributions to their day job plan, that's not going to reduce their ability to make employer contributions to the solo 401k because it applies at the employer level. Now, the one exception to that rule that you don't have to aggregate are 403b contributions. Any type of contribution to a 403b, whether it's employee, employer, together with any contributions that the individual wants to make to the solo 401k, the sum cannot exceed the overall limit. So now that takes us to the ability to make employer contributions as Roth contributions. This is now allowed thanks to the Secure Act 2.0. But really, based on experience and client feedback for our customers, it really wasn't a big deal because our plans already allow for mega backdoor Roth contributions, right? So our customers who who are interested in maximizing Roth funds in their solo 401k, by and large, would choose to make those contributions as voluntary after-tax contributions and just skip making employer contributions as Roth contributions. Why is that? Well, number one, you don't need as much money. You don't need as much earned self-employment income, W-2 wages, right? In the case of a business taxed as an S-Corp or a C-Corp, to be able to justify contributions all the way up to the applicable limit. Because when one makes voluntary after-tax contributions, you can contribute 100% of your wages, dollar for dollar, up to the overall limit. Whereas one needs a multiple of the amount that they want to contribute in W-2 wages, right? Because your ability to make an employer contribution, even a Roth employer contribution, is just a percentage, right? It's a fraction of your wages. You can only contribute 25%. So if you want to contribute $10,000 as an employer contribution, you need $40,000 of wages. Whereas if you want to make $10,000 as an after-tax contribution, you just need $10,000 of wages. From a deadline perspective, they're the same, right? Whether you're making employer or voluntary after-tax contributions, the plan would just need to be established in time to make those contributions by the business tax return deadline, including any timely filed extension. This is why I set up above that even for individuals who haven't set up a plan, who didn't set up a plan before the end of last year, before the end of December 31st, 2024, right now they would still have time to be able to set up a plan and make employer contributions and or voluntary after-tax contributions for 2024, as long as they set up the plan in time to make those contributions by the business tax return deadline, including any timely filed extension here in 2025. So it's easier to hit the max with voluntary after-tax. From a deadline perspective, it's the same. The third reason why, in our experience, customers would choose to just not make employer contributions as Roth contributions, but instead make after-tax contributions, is that one has more flexibility with after-tax contributions. So what I mean by that is that you can transfer those voluntary after-tax contributions out of the solo 401k to a Roth IRA. Whereas if one wanted to transfer employer contributions out of the solo 401k to a Roth IRA, you would need to meet a triggering event, such as being age 59 and a half or older. But let's assume that the individual wants to make employer contributions as Roth contributions. What are some of the FAQs, right? Number one, do I need to deposit those employer contributions made as Roth contributions into a separate account? The answer is no. Both employee and employer contributions made as Roth contributions may be deposited into the same bank or brokerage account for Roth solo 401k funds. Second FAQ, what is the contribution limit for employer solo 401k contributions made as Roth solo 401k contributions? Well, like we talked about, it's a percentage. Whether you're making pre-tax or Roth employer contributions, the limit is 25% of self-employment compensation, 25% of those W-2 wages, right? Box one of the W-2 plus any pre-tax elected deferrals, not in box one and over in box 12. Finally, how do I report employer solo 401k contributions made as Roth solo 401k contributions on my personal or business tax return? Well, this was an open question after Secure Act 2.0 was enacted for almost a year before the IRS answered this question. Because up until that point, historically, employer contributions were always made as pre-tax contributions. So it was always reported as tax deductible on the employer's tax return. But now that those contributions could be made as Roth contributions, there was a question, okay, well, if it's being made as an after-tax contribution, how are we going to report this on the tax return? So IRS Notice 2024-2 answered the question almost a year after the Secure Act was enacted, and it answered it as a two-step process. So employer contributions, even if made as Roth contributions, are reported as tax deductible on the employer's return. So just like a pre-tax contribution, it's going to reduce the taxable income, but then it's reported, and that's for the year for which the contribution is made. So if someone's making 2024 employer contributions in 2025, that'll be reported as tax deductible on the 2024 tax return. But then the IRS goes on to say it needs to be still taxable. So it's taxable to the employee for the year for which the contributions are deposited. So if it's a 2024 employer contribution deposited in 2025, it's going to be reported as taxable on the employee's tax return for 2025 via a 1099-R. All right, I see you're back. Let's go through the voluntary after-tax contribution limit, and then we'll field the question. So the voluntary after-tax contribution limit is 100% of W-2 wages from the self-employed business taxed as an S-Corp or a C-Corp, dollar for dollar, up to the overall limit. In other words, it's the lesser of self-employment compensation and the overall limit. Recall that the overall limit is $69,000 for 2024, $70,000 for 2025. Now, of course, you have to recognize that overall limit, right? So if other types of contributions are being made to the solo 401k, whether employee or employer, the sum of those contributions together with the after-tax contribution amount cannot exceed the overall limit. Now, it's noteworthy that the overall limit doesn't increase if one is over age 50 or older. So the point being here is that if you're making catch-up contributions, you're not making those catch-up contributions as an after-tax contribution. Those catch-up contributions need to be deposited either as a pre-tax employee or a Roth employee. So, but at the same time, when you're calculating how much you can contribute as an after-tax contribution, you can ignore those catch-up contributions. So you can still end up in the same place, right? For example, if you're age 50 or older, we're able to contribute $77,500 in sum to the plan. It's just that you have to put the $7,500 either as a pre-tax or a Roth employee. Now, just like Roth contributions need to have a separate sub-account, after-tax contributions need to have a separate sub-account. This is how one ends up with 3 different sub-accounts, right? Pre-tax, Roth, and after-tax. Now, unlike the employee contribution limit that applies at the employee level, the voluntary after-tax contribution limit applies at the plan level. So it's not reduced by contributions made to another plan sponsored by an unrelated employer, like a day job 401k plan, with the one exception to that general rule being if those other contributions are being made to a 403b. Then you've got to recognize the 403b exception, which provides that all the contributions made to the 403b, whether employee or employer, together with any contributions that the individual wants to make to the solo 401k, whether employee, employer, or after tax, the sum of those contributions cannot exceed the overall limit. So let's go. We want to go through those contribution scenarios, but let's first field this question. Thank you so much for coming back on the YouTube. My wife and I have a small business and we have a solo 401k established with your firm and we really enjoy the benefits. Oh, wonderful. Thank you. My wife would like to start an additional business soon that will require the use of employees. Can we continue to keep our solo 401k with our current business if our new business also sponsored a 401k plan for the employees of that business? So the answer is no. Because those 2 businesses in all likelihood are going to constitute either a control group or an affiliated service group, in which case the employees of the other business are going to be considered employees for purposes of the plan. And that means that you can't maintain a solo 401k because a solo 401k is for an owner-only business. Hopefully that helps. Please feel free to reach out to us for more specifics, obviously, with winding down your solo 401k if you end up going down that path. Appreciate you taking the time to join. Okay, now let's go back to this session. And again, if there are other questions or follow-up questions, please don't hesitate to ask those questions. Please like and subscribe to the YouTube channel as we are live twice a day. You can come and ask questions. You can also hear some of our content that we like to share. We appreciate the chance to discuss these topics. All right, so we want to apply these rules to different scenarios to paint the picture, to illustrate how they work. So the way that we like to do that is by going through various contribution scenarios. And the way that we like to go through those contribution scenarios is we start out with a baseline scenario, and then we change different factors to illustrate different points. So here our baseline scenario is a self-employed business, taxed as an S-Corp. There's one participant who's under age 50, does not make contributions to another plan. This individual's goal is to maximize pre-tax contributions and then make Roth and or voluntary after tax. Remember, I said that some people first want to maximize the Roth or only maximize the Roth, whereas others want to first maximize the pre-tax before they make Roth or voluntary after tax. So this individual is in the latter category. We'll change that factor in a moment. You can see how it works. This individual has $100,000 of W-2 wages. Of course, if they're making employer contributions, we're going to assume they make all those as pre-tax for the reasons mentioned up above. So in this scenario, this person would first maximize the pre-tax employee contributions, which is going to be $23,000 for 2024, 100% of their wages up to $23,500 for 2025. They're going to be able to make a pre-tax employer contribution of 25%. So that's another $25,000 into the pre-tax bucket. And then they're going to make the difference up to $69,000 for 2024, $70,000 for 2025 as a voluntary after tax, and then move the money over from the after tax account to the Roth solo 401k. That's the mega backdoor Roth, right? So at the end of the day, they're going to have $48,000 in their pre-tax account for 2024 and $21,000 in their Roth account for a total of $69,000. For 2025, they're going to have $48,500 in their pre-tax account and then $21,500 in their Roth after making that mega backdoor Roth contribution. So now let's change the scenario, and let's assume they have $50,000 of W-2 wages. How does that impact how much they can contribute? Well, it doesn't impact the employee limit because they're still able to do 100% of their wages up to the applicable employee contribution limit. It's going to impact their employer contribution limit because remember that's a percentage of those W-2 wages. So now that's $12,500. It's also going to limit their after-tax contribution amount because the sum of these contributions cannot exceed $50,000. So now they're going to do the difference up to $50,000. So another $14,500 as an after-tax for 2024, $14,000 as a voluntary after-tax for 2025, and then move those funds over either to a Roth solo 401k or a Roth IRA via that mega backdoor Roth solo 401k strategy. So now let's go back to the base, back to $100,000 of W-2 wages. But here, let's assume that the individual has maxed out contributions to a day job plan. How does that impact how much they can contribute to the solo 401k? Well, they're not going to be able to make any employee contributions because they already hit the limit by maxing out contributions to their day job plan. The employer contribution limit is going to stay the same, right? Because it's 25% of the $100,000 of W-2 wages. And now they're going to be able to go up to the overall limit, the difference, as a voluntary after tax. So remember that this is a good point as it illustrates how the voluntary after tax contribution limit is not reduced by contributions made to a day job plan. So this person's going to be able to contribute another $44,000 as a voluntary after tax for 2024, and then move that to the Roth solo 401k for a grand total of $69,000. For 2025, they're going to be able to contribute $45,000 as a voluntary after tax, and then move that over to the Roth solo 401k for a grand total of $70,000. So now let's go back to the base. $100,000 of wages. They don't make contributions to another plan like a day job plan. Here, they're not interested in making pre-tax contributions. They're only interested in making Roth or voluntary after tax. So they're going to make 100% of their wages as employee contributions, but instead of depositing it into the pre-tax account, this individual will deposit to the Roth. So $23,000 for 2024, $23,500 for 2025. They're not going to make any employer contributions because they're not interested in making pre-tax contributions, and they'll just do the difference up to the overall limit as a voluntary after-tax contribution. So $46,000 for 2024, $46,500 for 2025 via the mega backdoor Roth, and then move those funds over to their Roth solo 401k. So for 2024, they've now contributed $69,000 that's now in their Roth solo 401k. For 2025, $70,000 in their Roth solo 401k. So now let's go back to the base. And here we're going to assume that there's actually two participants. Let's say it's a husband and wife that are both working in the same business, both participating in the solo 401k. So this is a great point, as it illustrates that the amounts don't change. But here what we're illustrating is that the ability to contribute is based on each participant's scenario. So each person has $100,000 of wages. Each person is under 50 years of age, right? Each person doesn't make contributions to another plan, etc. So therefore, each person is able to contribute these respective amounts. So now let's go back to the base. One person doesn't make contributions to another plan. They first want to maximize pre-tax and then make whatever they can else as Roth and voluntary after-tax. They have $100,000 of W-2 wages. But now let's assume they're 50 or older. How does that impact how much they can contribute? Well, it now allows them to make a catch-up contribution. For 2024, the catch-up contribution, if you're age 50 or older, is $7,500. For 2025, it stays at $7,500. But if they're age 60 to 63, now they're able to make a super catch-up contribution amount or contribution in the amount of $11,250. This is also a good scenario as it illustrates how that voluntary after-tax contribution limit doesn't increase if you're age 50 or older, but you also don't have to reduce how much you can contribute as a voluntary after-tax by any catch-up contribution made. So you still end up being able to contribute that same amount as a voluntary after-tax contribution. All right, great. So now let's go back to the base. Back to being under 50. Here, though, we're maxing out contributions to a day job plan. But here, we're not interested in making pre-tax contributions. We're only interested in making Roth and voluntary after-tax. So they're not going to be able to make any employee contributions because they already maxed out to their day job plan. They're not interested in making employer contributions because they're only interested in making Roth and voluntary after-tax. So that means they're going to make the full contribution, $69,000 for 2024, $70,000 for 2025 as a voluntary after-tax contribution, and then move those funds over via the mega backdoor Roth to a Roth solo 401k or a Roth IRA. All right, great. So now let's go back to the base. Here, let's assume that the person is now 50 or older. They're maxing out contributions to their day job plan. They're only interested in making Roth and mega backdoor Roth contributions. So it's the same, right? They can't make employee because they max out to their day job. They don't want to make employer because they only want to make Roth and mega backdoor Roth contributions. So it's just a good illustration that that voluntary after-tax contribution limit doesn't go up when you're age 50 or older. And here the person made the catch-up contribution to their day job plan. So it's going to be the same situation as the prior scenario, right? Where they make $69,000 as a mega backdoor Roth contribution for 2024, $70,000 as a mega backdoor Roth contribution for 2025. So now let's go back to the base. We're back to having two participants. Let's say again, the husband and wife. Same profile for each person though, right? Each person maxes out to their day job. Each person's not interested in making pre-tax contributions. Each person has $100,000 of W-2 wages. So it's going to be again, you illustrate that the ability for each person to contribute to the plan is based on their situation. So each person's not going to be able to make employee contributions to the solo 401k. Each person's not interested in making pre-tax contributions and pre-tax employer contributions to the solo 401k. So each person just simply makes the full mega backdoor Roth contribution as a voluntary after-tax contribution, $69,000 for 2024, $70,000 for 2025. It doesn't go up, right? Because they're age 50 or older and they already made the super catch-up or the catch-up contribution to their day job plan. So, or actually this person's under 50, but in any case, it wouldn't go up even if they were over 50, like we learned in the prior scenario. But they're able to contribute that full mega backdoor Roth contribution to the solo 401k and then move it over to the Roth. All right, great. So now let's take a look at one of our resources, which is our calculator. You can access it easily on our website, mysolo401k.net. First, under the Learn menu, just click on Online Tools. You can choose your business type, right? Corporation. You can enter your W-2 wages. Remember, it's box 1 of the W-2 plus any pre-tax elected deferrals, not in box 1, but over in box 12. Enter your age. You choose the year, 2024, 2025. And it gives you this nice printout so you can easily see what those contribution limits are. It also contrasts and shows how much more one can contribute to a solo 401k versus a simple versus a SEP. Now, noteworthy that you would need to modify it if you are making contributions to a day job plan, modify if you want to make after-tax contributions. So now let's keep going with the mechanics. How do I make contributions? Well, from a solo 401k perspective, it's totally acceptable to make those contributions via check, via electronic transfer. Now, of course, if you're going to make them via electronic transfer, you need to check with the institution that holds your solo 401k account just to determine their procedure to receive an electronic deposit. For example, many of our customers want to have a brokerage account for their solo 401k, and we're very hands-on in helping them open up brokerage accounts. One of the most popular options is Fidelity, but that's not the only option, right? Schwab, for example, an option. E-Trade's an option. So in general, the brokerage firms do not allow for electronic deposit from an external account where the name on the external account doesn't match the name on the brokerage account, with the exception being Fidelity, which does allow for electronic deposit from an external account. Like, let's say you want to transfer the money from your business account, right? In that case, the names wouldn't match. Another thing that's noteworthy is that each participant deposits his or her contributions into separate sub-accounts, as well as having separate sub-accounts for different types of funds, like pre-tax, Roth, and voluntary after-tax. This is how one ends up with, say, 6 accounts, right? Because they have pre-tax, Roth, and after-tax for 2 participants, like a husband and wife. Let's keep going with the mechanics, right? When is the deadline? Well, what's great is if you have a self-employed plan, like a solo 401k, under the rules, you have more time to make contributions. We've got an excerpt here, for example, from IRS Publication 560, which is the landmark guidance for self-employed retirement plans like solo 401ks. So as long as that solo 401k plan is established by the end of the year, like say you signed up on or before December 31st of 2024, you preserve the ability to make all types of contributions for 2024 by your business tax return deadline, including extensions. So that's March 17th or September 15th if you file a timely extension and your business is taxed as an S-Corp, April 15th or October 15th if you file a timely extension for your C-Corp tax return. So this is a great slide as it just illustrates how the deadline really ties to how the business is taxed. And likewise, here are the deadlines for 2025. Now let's keep going with the mechanics, right? How do I report contributions? Well, it depends, right? As we've learned, right, there's different types of contributions. So it depends on whether you're making employee versus employer, whether it's pre-tax, Roth, or after-tax. So if it's a pre-tax employee contribution, that reduces the amount in box 1 of the W-2 and is instead reported over in box 12 using code D. And then you check the retirement plan field in box 13. Whereas if it's a Roth employee contribution, that's made on an after-tax basis. It's not going to reduce your income in box 1 of your W-2, but it's still reportable on the W-2, specifically in box 12 using code AA. Again, check retirement plan field in box 13. In addition, our plan allows for voluntary after-tax contributions. Voluntary after-tax contributions are a type of employee contribution. Per the W-2 instructions, though, reporting those voluntary after-tax contributions on the W-2 is optional. doesn't have to be done. It's not required. But if the individual chooses to report those voluntary after-tax contributions on the W-2, it may be reported in box 14 of the W-2. Of course, just like the Roth employee contribution, it's made on an after-tax basis, so it's not going to reduce box 1. Now let's talk about employer contributions, right? As we learned per IRS Notice 2024-2, now that one is able to make Roth employer contributions as Roth contributions, there was that open question about how to report those contributions. And that notice clarified that even if one is making Roth employer contributions, it still needs to be reported as tax deductible on the employer's return for the year for which the contribution is made. So if a business is taxed as an S-corporation, both pre-tax and Roth employer contributions are reported on line 17 of the Form 1120S, the S-corporation tax return. Whereas if the business is taxed as a C-Corp, it's reported on the C-Corp tax return, the 1120, specifically line 23. And then if the employer contribution is made as a Roth contribution, it needs to still be taxable, right? Because those are made on an after-tax basis. So it's taxable to the employee for the year of the deposit. So if it's made in 2025, but for 2024, it's going to be taxable to the employee in 2025. And it's taxable to the employee via a 1099-R. So a 1099-R would be issued for 2025. Just clarify that typo real quick. All right, let's keep going with the mechanics. How do I convert after tax to Roth? Well, from a solo 401k perspective, it can be converted by check, by electronic transfer, whether ACH or wire. It can go between bank and brokerage. You can transfer those voluntary after-tax funds to either a Roth solo 401k or a Roth IRA. Now, the steps are going to depend. We wanted to go through a couple of topic brokerage firms, right? Those being Fidelity, number 1, Schwab, number 2. So you would first make the contribution. It would need to go into a separate voluntary after-tax account. So as part of the onboarding process, we help customers open up accounts at the bank or brokerage of choice. It's a free brokerage account at Fidelity, right? They don't charge anything to set it up. There's no maintenance fee. Same thing with Schwab. The funds are then converted to Roth. So it can either be converted to another brokerage account at Fidelity for the Roth solo 401k, so an in-plan conversion, or it could go to a Roth IRA, including a pre-existing Roth IRA at Fidelity. Step 3, customers need to give us the information we need to prepare the 1099-R. Because the first step, the contribution, right, we saw it's not reportable, right? It's optional to report on the W-2. But the second step, to move the money to the Roth, that is reportable. And we have online forms that clients can use to provide us the information we need to prepare the 1099-R, which we handle as an optional free service for our customers, right? As long as customers provide us the information in a timely fashion, we'll prepare it. So it's going to be the same process with Schwab, right? Separate brokerage account at Schwab for after-tax funds, move the money either to a Roth or a Roth solo 401k or a Roth IRA, then let us know about the transfer so we can capture the information needed to prepare the 1099-R. That brings up the question, should I convert to Roth IRA or Roth solo 401k? Well, the differences have gone down. They become more alike, right? For example, both Roth IRAs and Roth solo 401ks are no longer subject to require minimum distributions. Roth IRAs, you still cannot have a participant loan. So for customers that want to keep that option open to be able to borrow those Roth solo 401k funds as a 401k participant loan, they need to keep the money in the Roth solo 401k. The ability to invest in alternative investments, right? That's another reason that folks will keep the money in the Roth solo 401k, because our plan allows for alternative investments, whether that's real estate, crypto, private placements, etc. Whereas it's much more difficult to have a Roth IRA that invests in alternative investments. Like if you have a Roth IRA at Fidelity or Schwab, etc., they're not going to allow you to invest our Roth IRA money into real estate or crypto, etc. Now, digging deeper with the alternative investment scenario, some of our customers want to invest on a leverage basis. For example, invest in real estate together with debt, pair their retirement money together with debt. So if one invests their Roth IRA money on a debt finance basis, so they use debt along with their Roth IRA money to acquire real estate, the income attributable to that debt finance real estate investment is going to be subject to UDFI, unrelated debt finance income tax. So that means that the Roth IRA investment is not going to make as much money because it's going to have to pay taxes, right? And you're still going to have to pay taxes again, potentially, when you take it out of the Roth IRA, unless you take it out as a qualified Roth distribution. Whereas with the solo 401k, there's an exception to that unrelated debt finance income tax rule with respect to income from debt finance real estate investments inside of 401k. So for those that are looking to invest in real estate using debt, investing via a Roth solo 401k has much more advantage. It's much more advantageous in terms of the UDFI tax. Lastly, let's talk about the rules when it comes to withdrawing funds from a Roth solo 401k versus withdrawing funds from a Roth IRA. So in order to withdraw funds from a Roth solo 401k, you need to meet a triggering event, such as being age 59 and a half, etc. Whereas one can withdraw money from a Roth IRA at any time. You just have to consider the ordering rules, where you first, for example, withdraw the basis, in other words, the contributions, the conversions, before you get to the gains. No deadline to convert. So of course there is a deadline to make the contribution, right? Like we saw about how it has to be made by the business tax return deadline, including extension. That's the first step. But then the second step is to move the money from that after-tax account either to a Roth solo 401k or a Roth IRA, right? That's why we talk about how a mega backdoor Roth is really a two-step process, right? First, the after-tax contribution, and there's a deadline to do that, and then move it from the after-tax solo 401k account to either a Roth solo 401k or a Roth IRA. No deadline for the second step. No deadline to convert. Now, when you do convert, though, it's reportable, but it's reportable for the year of the conversion. This is why, for example, many people might be making 2024 contributions here in 2025, which means they're not going to, of course, convert until at least 2025. So if they convert from the after-tax to the Roth here in 2025, that'll be reportable on a 2025 1099-R, even though the source of the money was 2024 contributions. Tax reporting, right? So the amount that you contribute is made on an after-tax basis, so it's not taxable. But to the extent that there are any gains that accrue in that after-tax account before it's converted to a Roth solo 401k or Roth IRA, those gains are going to be taxable and reportable on the 1099-R and then reportable on the 1040 as taxable income. But it's typically a very small amount. So this is some good slides here as it illustrates the account setup, right? Like we talked about how you have to have separate sub-accounts, right? Pre-tax versus Roth versus after-tax, or 6 accounts if you have 2 participants, right? Pre-tax, Roth, and after-tax for each of you. Now, if you're moving the money from the after-tax account to a Roth IRA, you might just have 2 or even just 1 if you only have after-tax money in the solo 401k, right? So you first deposit to the after-tax solo 401k, then the funds move out of the solo 401k to a Roth IRA. All right, before we talk about the tax credit, let's go back to the questions. Thank you for your patience. Thank you for bringing the questions. Yes, if the spouse's business doesn't have any full-time non-owner, non-spouse employees, because, for example, everybody works as a contractor, then that would allow them to continue to maintain the solo 401k. Great question. So again, if you have questions or topics you want to discuss, please don't hesitate to chat it over. Again, please subscribe to the channel. You get all the notifications. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern. Then we come back in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. We also have a lot of deep dive content. So it's a great way to learn, to engage, hear what other people are asking, etc. Let's get another question in before we go to the tax credit. If I switch from a sole proprietor to an S-Corp, is that okay? Yes. You would just need, the plan documents would need to be updated. So if you go to our support page, for example, you can follow the steps to get into that process. The accounts for the solo 401k, the name of the solo 401k, the investments in the solo 401k, those aren't going to change. It's a document update. So our plan makes the self-employed business eligible to claim $1,500 in solo 401k tax credits. So the background here is that the Secure Act authorized a number of tax credits to encourage small businesses to set up a 401k plan, right? To try to solve the retirement savings crisis or help solve it. Now, one of those credits, the startup cost credit, is not available to a solo 401k because in order for a business to be eligible for the startup cost credit, the business has to have non-owner employees participating in the plan, which of course, by definition, a solo 401k plan would not because it's an owner-only plan. But there's another credit that was made available under the Secure Act, which is the automatic participation credit, or they also call it the EACA credit. In order to be eligible to claim that credit, there's no requirement to have non-owner employees. So that means that an owner-only plan or owner-only business that sets up an owner-only plan, like a solo 401k, that includes the features, the notices, et cetera, like ours does, will be eligible to claim the credit. It's $500 per year for 3 consecutive years. It's available to both new solo 401k plans or even existing basic solo 401k plans that are upgraded to our plan. They'll automatically, when we prepare the documents to restate the plan, we'll automatically include the features and the notices, et cetera, to make the self-employed business eligible. And under the rules, existing plans that adopt the feature will be eligible to claim the credit. We'll also point out that this credit is not a function of the cost. So unlike the startup cost credit, which is a function of the cost to set up the plan, here, these credits, these $1,500 in credits, is not based on the actual cost to set up and maintain the plan. So even though our fees are much less than $1,500, the business would still be able to claim the full credits. So if the individual signs up for a new plan here in 2025, they'd be able to claim the credits starting in 2025 with their 2025 tax return, and again for 2 more years for a total of $1,500. If the individual were to sign up in 2026, they'd be able to start claiming the credit when they file their 2026 tax return, and then again for 2 more years. If somebody already has a solo 401k and then upgrades it to our plan in 2025, they'd be able to start claiming those credits when they file their 2025 tax return. Likewise, if they did it next year in 2026, they'd be able to start filing and claiming the credit when they file their 2026 tax return. It has a tremendous impact on the cost. As we talked about, it's not a function of the cost. So for example, we charge $650 as the initial cost, which includes the $525 establishment fee plus the first $125 annual fee. So in your first year, the net cost is $150. In the second and third years, the value of the credit greatly exceeds our fees, right? We charge $125, but the individual is able to claim $500 in credits. So in short, this $1,500 is going to more than cover our fees for the first 7 years. It's also noteworthy this is a tax credit, not a tax deduction. With a tax deduction, the individual reduces their taxable income, right? Reduces their income upon which their tax liability is calculated. Whereas with a tax credit, the individual first determines their tax liability, and then they're able to reduce that dollar for dollar by the value of the credit. So in that way, tax credit is much better than a tax deduction. So again, you just need to set up a plan like our plan that includes the automatic contribution feature. What is the automatic contribution feature? Well, it sets a default 3% contribution percentage, but you, as the solo 401k participant, have the right to opt out of the default contribution amount and then decide to make contributions at whichever amount or schedule you prefer. Opting out of the default amount doesn't mean that the individual doesn't qualify for the credit. They still do. As we talked about, if you have an existing plan, it could be upgraded to our plan, and now the business will be eligible to claim the credit. How do I claim the credit? It's claimed by filing Form 8881. We hosted a deep dive webinar with an IRS enrolled agent that goes through step by step how to claim the credit. So it's a short 2-page form, but we provide that content to make it easy for our customers. So just a couple quick examples. Lindsay's self-employed and has a solo 401k plan. If she amends her plan here in 2025 to add the auto contribution feature, she'll be able to start claiming the credit when she files her 2025 tax return, and then again for 2 more years. Whereas Brad, he's a solo attorney with no employees, therefore eligible to set up a plan. If he signs up here in 2025, he'd be able to start claiming the credit when he files his 2025 tax return. Then again for 2 more years, as long as he continues to maintain the plan with the automatic contribution feature. All right, great. Well, we really appreciate all the participation, the great questions. We do have a little bit more time. If there's more questions, please continue to engage. Please subscribe on YouTube. We'll be back. We're back twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern. So if you subscribe and hit the notifications bell, you can jump on the live session and ask questions. We also have a lot of contribution seasons. We have a lot of great contribution content in the pipeline. So if you subscribe, you also get notifications there. In making the thank you for the good question. In making the contribution for employee, is it okay to be deposited from the business checking account for the amount? Yes, from a solo 401k perspective, it's totally acceptable for contributions to be made from the business account or the personal account. Either is acceptable. What's really more important is that the contributions are made within the limits, by the deadlines, etc. All right, well, we'll give it another moment just to see if there's any more questions. Looks like it takes us to the end for today. Thank you so much, everyone. Take care.